there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Bloomberg is reporting Canada Pension Plan Investment Board has halted its sale of fund stakes. Additionally, La Caisse is suspending an undertaking to sell an estimated $1.5 billion of Chinese private equity assets. According to the report, the potential sales were stopped as buyers offered to take the portfolios at discounts. And we are watching shares of Keyera, AltaGas, and CN Rail today. The companies are partnering to advance the Alberta Corridor Export Rail Terminal project. The partnership includes an initial investment by Keyera of about $240 million. The companies say the project will strengthen Canada's energy competitiveness, as well as expand access to global markets and support long-term economic growth. Meta has begun a round of layoffs for thousands of employees. The previously announced restructuring will cut 8,000 jobs globally and aims to reduce costs as the tech giant invests heavily in artificial intelligence. According to reports, Meta's latest round of cuts is expected to hit its engineering and product teams. Additionally, more layoffs could come later this year. And we're watching the TSX today. It is up 1.2% at the moment, above that 34,000 point threshold right now. Continuing to watch that, it seems as though U.S. markets also in the green. The Dow Jones and the Nasdaq both up above 1% as well. Investors waiting for Nvidia's earnings report that's coming out tonight after the bell, and really waiting to see where the direction of tech is going to go and whether Nvidia can point some signs as to where it's going. Markets are continuing to push higher, as you can see here, driven largely by strength in technology names as investors look ahead to a key test for the AI trade with Nvidia earnings just around the corner, as I just mentioned. Joining us now to expand on tech and other trends is Bruce Campbell, founder and portfolio manager at Stonecastle Fund. It's great to have you join us. Thanks so much.
Yeah, thanks for having me on, Lindsay.
So do you think when we see Nvidia's results coming out later today, that will be able to point investors a clear sign of where, tech companies are going?
I mean, when we look at the numbers, they certainly have had an impact in the past. And if you look at the investments that Nvidia have been making into other companies, that's also had a big impact as well. So we'll wait to see what the results look like. And there's, certainly high expectations that those results will continue to be strong. And then also to, watch and see what they say about the sector and the demand for the sector itself.
What exactly are you going to be watching for with Nvidia's earnings tonight?
I mean, the big thing is probably beating the expectations, right? And the expectations keep going up. The estimates now are close to 10% above what they did last quarter. So the numbers keep getting higher. And I mean, at some point in time, it's going to be hard to beat those expectations. They've been doing, a fantastic job of having stronger numbers each quarter, and that continues. And that's really what's driving this whole technology trade, where there's so much money being earned in that sector.
Yeah, and markets right now pricing in about a 5% move in Nvidia shares after earnings. And as you say, Nvidia has seen extraordinary growth, but with that growth comes even more pressure, right? Is the bigger issue now about valuation rather than fundamentals for this company, do you think?
I mean, the valuation has always been certainly stretched on this company, and it hasn't changed anything at this point in time. But you look at what they've done over the last 5 years; they've grown earnings at 50%. And their price earnings ratio is right around 50 right now. So that certainly is a high, historical multiple for any company. But when you're growing at 50%, that awards that multiple. The challenge will be what the growth rate is going forward, and when and if that starts to slow. It'll slow at some point in time. It's just a function of when.
You also pointed to elevated short interest in Nvidia. Can you kind of elaborate on what you mean by that?
Yeah, I mean, if you look at historical short interest on Nvidia, and this is the last report, so Nvidia has made a move up since then. It was around 2 days short interest, which is, fairly high for that stock. That being said, I mean, when we look at that, expected relative volatility on the day of 5%, it could really move either way just because there'll be a lot of options that offset that short position, and that short position could have come down. But when we look at it over a historical time frame, that is relatively high for Nvidia.
Outside of mega cap tech, where are you finding opportunities right now in the market?
Yeah, I mean, the whole technology sector continues to be strong for us. And if you look, through all market capitalizations, if that's, the small caps or the intermediate and mid caps, there's certainly a lot of earning strength there. And then if you look at, a lot of the resource companies, there tends to be a lot of earnings there as well, because we've seen the commodity prices continue to, to ramp up, if that's oil, if that's copper, if that's gold. And so those numbers continue to be really strong. And then we also look for, a number of different special situations that have really been driving, nice returns for stock prices.
Let's talk about those kind of special situations that you were talking about. What are some of those examples, and what makes those names kind of interesting in this environment for you?
Yeah, I mean, one that we really like and have for a while, I've talked about it when I've been on market call, is Energia, which is a renewable natural gas company. And what they do is they have technology and build the systems to really use bio waste to produce natural gas. And if you look at this company, it went public sort of just around the COVID timeframe, and had run into a lot of challenges, and then was recapitalized and has come out with a lot of strength. They continue to gain a lot of traction with contracts. They have a little over $300 million backlog right now, and their bid pipeline is over $1 billion. And if you look at what they did, they went from losing money to now where they're basically break even and starting to make some money on a quarterly basis. And you continue to see bigger contracts. So they just signed one recently here for 58 million, which is, fairly significant when you think about their backlog being just over 300 million. And that's going to be driving those earnings. And I think that the renewable natural gas trend is going to continue for some time.
How important is diversification right now when we're seeing like so much of the market's performance coming from a handful of AI related names instead?
I mean, we've seen this for sure. If you look at, the last, not today, but the last 3 or 4 days in the market, when technology was being hit, the market was going down, and some of those other sectors had held up relatively well. And then you saw, technology really getting hit, and especially the high momentum technology names, the ones that, people have chased and really gone after as the share prices have moved higher.
If we do see a pullback in tech at any time, what parts of the market do you think could actually attract capital next?
The resource companies continue to see very strong earnings, so there's opportunity there. And then with with some of the sell-off in tech, that was really created around the concern of higher interest rates, and higher interest rates are often good for some of the financials, select financials. So financials could be strong, and then if you look at the at the commodity stocks, they also could be quite strong. So Canada, that really rewards Canada with such a high exposure to financials and commodity exposure, both oil and gas, and then mining and materials.
Okay, we'll have to leave it there. We're out of time. Bruce Campbell, founder and portfolio manager at Stonecastle Investment Management. Appreciate you joining us. Thanks so much.
Yeah, thank you.
Up next, global yields are on the rise this week as investors continue to sell their government bonds on concerns that inflation is here to stay. We're back in a moment with more. Global bonds are selling off this week. The 30-year Treasury yield is hovering around its highest level since before the 2007 financial crisis. This increase reflects ongoing investor concerns about a potential resurgence in inflation. So let's bring in Vishal Kanduja, head of broad markets, fixed income, and portfolio manager at Morgan Stanley Investment Management. Good afternoon. It's great to have you join us.
Good afternoon. Thanks for having me on.
So as we're watching this kind of bond sell-off today, yields going higher, at what threshold do the 10-year and 30-year Treasury yields become economically destabilizing? Or have we already reached that point?
I think we are in that danger zone, Lindsay, where we've reached a level where you're pricing in probably about 20 odd basis points of hikes by the end of this year, and then about 2 hikes next year in the US market and a lot more if you look in the UK or Europe or even Japan at this point. So we are at this point where a new mortgage or a new homeowner, a potential new homeowner who's getting a new mortgage is already feeling as if the Fed has hiked a couple of times. So that is definitely going to start showing up in the next 2 months worth of growth and inflation data across the developed market.
Right, and as we're seeing, like the market now pricing in the higher odds of a Fed hike, as you mentioned, do you expect that we'll get one in 2026?
We don't think that the next move from the Fed, whether it's 26 or 27, is going to be a hike. We still think that the next move is going to be a cut, and not just because we think that there is going to be a new Fed chair that is going to be much more pressured by the White House, but the economic data is going to allow the Fed, but it's going to take some time and much more clarity from the conflict that we've gotten into here in the Middle East. But we do think that given the economic data, given the economy, given the pressures of higher interest rates starting to seep through in the next couple of months, the next move, even though a little pushed back one, will be a cut rather than a hike.
Okay, so going back to the recent increase in long-term yields, I know there's a lot of fears of inflation, but to what extent is this rise driven by a higher risk premium related to fiscal credibility instead?
Fantastic question, Lindsay. And a lot of that, I think there are 3 basic factors to explain a lot of that. One, I think definitely growth inflation. I think the 2 primary drivers. Fiscal health is another big driver of yields and shape of the curves, meaning the steepening of the yield curve that you quickly referred to as well. The initial shock that we got probably for the first 6 weeks post the end of Feb was clearly and only driven by the war-driven price shock that we got in countries that were importing, got a little bit more sustained, and countries that were exporting oil got quick in the very front end energy price shock related or break-even related move in nominal curves. In the last probably 3 to 4 weeks, we've seen the move driven by real yields, which is more from not only from growth not showing the demand destruction that the market thought would come, given the oil prices are higher, and then also some of that steepening that has come through, which is the second part of the sell-off that we saw, which is again bringing in countries like the UK are much more in that focused sort of sell-off rather than the US. A lot more in Japan we've seen because of the new supplementary budget that came out that again goes back to the fiscal health, et cetera. And then you can throw in the last piece that is adding volatility is the political issues, more centered around in the UK rather than the other parts of the developed world. But all of those factors are starting to show up and percolate at a time when a new Fed chair is going to take seat on Friday.
So interesting. Are you concerned that rising long-term yields will quickly raise borrowing costs for credit cards, mortgages, things like that?
It should. That is the sort of self-correcting mechanism that is inbuilt in yields going higher, and 10-year is the point that you should focus on because most of the loans are made on the 10-year point or versus the 10-year point. So yes, I think you're starting to show sort of some of those signs that are seeping through the economy. Now, again, real time, it's difficult to see through that. But historically, we've seen time and again around this 4.50, 5% on the 10-year in the US, you start to see some of those growth slowing mechanisms starting to show up.
Do you consider the current sell-off a good buying opportunity? And if so, are there specific markets you find particularly attractive, maybe emerging markets as well?
Fantastic buying opportunity. Again, yields in any developed and emerging market are fantastic and highest efficacy indicator of total returns for fixed income investors in the next 1, 3, and 5 years. If you can hold on to some of these volatile periods, I think these are fantastic entry points for fixed income investors. But typically, entry points come in when there is a lot more volatility in the market. We do think that U.S. And European rates offer compelling opportunities. Front end of Canada, front end of New Zealand offer compelling opportunities. Some of the countries in the LATAM with extremely high real and nominal rates, with the central banks there have done a lot of work, hard work over the last 3 years, and are exporting commodity that is 60% higher at this point. So all those are fantastic sort of buying opportunities from adding duration. And I think the other thing that has happened is central bank rates versus the 2-year or 3-year part of the curves are also steep now. So you're starting to see some of those investors who were stuck in that treasury bill or cash are starting to move out the duration spectrum as well. So we do think that the zone of 450 to 5% is a compelling entry point for fixed income investors.
Okay, we'll have to leave it there. Vishal Kanduja, head of broad markets, fixed income, and portfolio manager at Morgan Stanley Investment Management. Thanks so much for your time. Appreciate it. Up next, why are investors cooled toward U.S. retail giants Target and Lowe's despite beating first quarter earnings? We'll have details after the break. U.S. retailer Target beat first quarter revenue and earnings estimates and raised its sales outlook for the year. Home improvement retailer Lowe's, meanwhile, also posted beats on first quarter top and bottom lines and maintained its full year guidance amidst a sluggish housing market. So let's find out more about their results from David Bellinger, senior retail analyst at Mizuho Americas. It's great to have you join us. Thank you so much. Let's start with Target. An earnings beat, strong sales under a new CEO's first quarter, revamped strategy. Down more than 4%, though, at the moment. What do you think's happening here?
Hey, great. Thanks for having me on. So Target had an incredibly strong quarter. You had same-store sales growth of nearly 6%. That was one of the best numbers in a long time. First positive one in over a year. So good momentum with Target. We think this was a bit of an aberration. You had a big amount of tax refunds flowing into the U.S. You also had some of these deeply negative sales comparisons that they were up against last year, some of this boycott activity that was taking shape. So Q1 seems almost as if a bit of an unsustainable number. Still very good, though. And then on the call today, even though management was raising certain components of their guidance for the year, they did have a bit of, I'd say, cautionary commentary on the second quarter. There's a lot of consternation out there around spending slowing down, higher gas prices, and Target was also warning a bit about this Nintendo Switch 2 console that dropped last year in the second quarter. We think that might have added a full percentage point of same-store sales growth. So just things to be cognizant of, and we should see some type of deceleration into Q2. And I think that's why you see the stock down today.
Yeah, and obviously with that cautionary tale about Q2 and how it's just harder when you look at comparable sales, like the company still raised its outlook, its sales outlook for the year. What do you think is the reasoning behind that after cautioning about the second quarter?
Yeah, that's right. And it's the raised full year guidance is all a function of the Q1 outperformance. So they didn't really touch Q2 through the balance of the year. Again, a little hesitant there, some cautionary comments. But yeah, there's a lot of unknowns out there, especially with this big tax refund benefit running out. That was $320 billion or so of disbursements, up 18% year over year. Definitely benefited a lot of retail companies, consumer companies in Q1. With that fading, and then also with these potential inflationary pressures starting to resurge again and build back up with the Iran conflict and a lot of uncertainty there, it seems like we may have a wave of price inflation in the back half of the year. Just a lot of these management teams are taking a bit of a more prudent approach to the rest of 2026.
And all of the company, when we're still talking about Target, core merchandising categories showed growth. Does the retailer need to focus more narrowly on the most profitable segments? And if so, which ones?
I say not necessarily. There's a lot of work to be done ahead for Target, and that's in some of these core business categories like apparel and home, where they've done really well in the past, but sort of lost their touch. The merchandising just took a step back over the last few years, and I make a parallel to Five Below had an issue like this where a lot of merchants, they moved to Zoom, they're working from home, weren't in touch with the product like they should be. And it seems like Target is actually recapturing some of that merchandising acumen again. They've got a lot of their employee base back in the office in Minnesota, and you're starting to see some improvements in the merchandising. But we think this takes a little while longer to get going. They did have some good comments around like baby category. Trading cards have been super hot for them. So some of these categories are getting there, but there's still a lot of work left for Target to get done.
Okay, so let's switch gears and move on to Lowe's. It had a narrower beat on earnings and revenue. Stock is relatively flat at the moment. Investors didn't seem to be entirely happy with these earnings results either. Why do you think that is?
Yeah, this was a largely inline quarter. We got a data point at a Home Depot yesterday, very, very similar. Both companies are keeping their full year guidance intact, no real changes there. And then Lowe's today on the earnings call, they talked about same-store sales growth getting a bit better in Q2, about a 1% growth versus fractionally positive in the first quarter. But again, this is a function of comparisons, right? It's not as if the home improvement category is seeing a rebound in demand. It's just been a very, very stagnant category. You've got affordability issues in the U.S. Homes are largely unaffordable. You've got incredibly high interest mortgage rates, at least versus a few years ago. So there's a lot of activity in the categories being held back. It seemed like more of the same out of Lowe's today. Stock's off the lows, but it is pretty flattish today at best, I'd say.
What's your outlook on potential catalysts for this sector and the Lowe's stock in particular moving forward?
Yeah, for Lowe's specifically, throw Home Depot in there too. When this category recovers, it'll be incredibly powerful. You've got this almost coiled spring effect. It's very hard for investors to underwrite a specific catalyst path, or maybe we get lower rates at some point. That narrative's kind of turned lately. But I think one of the biggest points here is just the category has been so depressed, and there's almost this digestion period. We feel like we've almost gone through all of this of 2020, 2021, 2022. There's so much spending around the home. There's almost somewhere over $50 billion of lost activity that these companies point to. So when this comes back, it'll be very powerful. And again, Home Depot and Lowe's, they're also going out and purchasing these large, complex pro businesses. So think about larger remodelers, larger home builders, those big activities, those big projects. That's where they're sort of moving these businesses to. And those are a little more steady. But as the category comes back, they should see a real uptick in demand. And I think that's what investors are eventually playing for here.
Okay, David Bellinger, we will leave it there. Appreciate you joining us today. Thanks so much.
Great, thank you.
Coming up, we'll see how artificial intelligence is gradually reshaping operations in the banking industry in a chat with Barclays CEO. That's next. Stay with us. We are watching shares of Keyera, AltaGas, and CN Rail today. The companies are partnering to advance the Alberta Corridor Export Rail Terminal project. The partnership includes an initial investment by Keyera of about $240 million. The companies say the project will strengthen Canada's energy competitiveness, as well as expand access to global markets and support long-term economic growth. And Sherritt International is in talks to hand a controlling Cuba mine stake to Gillian Capital. That company is linked to a former advisor of U.S. President Donald Trump. Sherritt says it has signed a non-binding agreement which would allow Gillian to acquire enough common shares to own more than half of the company. Sherritt says it has spoken with the U.S. Department of State, which has no objections to Gillian's engagement. And shares of TJX are getting a lift today. The retail chain raised its sales and profit outlook for the full year as cautious shoppers spend more on lower-priced goods at its discount chains. TJX also posted sales and profit in its latest quarter that topped estimates. On the downside, though, the company's fiscal 2027 outlook now assumes a higher cost of fuel, which will remain in place for the rest of the year. Barclays Chief Executive Officer C.S. Venkata Krishnan discusses the use of artificial intelligence in the banking industry during a conversation with Bloomberg, saying the technology is having a creeping impact on the UK lender. He also commented on global central banks' policies. Here's part of that conversation.
I think they have a really tough job. And I think, unfortunately, it'll be one of those cases we look back in a year and say, oh, they shouldn't have done this, they should have done that. Or they were wonderful to have done this. But I think I think the real question is going to be balancing growth versus inflation. And I think it's a bigger risk in the UK and Europe than it is in the US. The US is still growing pretty well.
When you look at AI, and you're talking a little bit about AI valuations, what are we getting wrong? So is there too much CapEx? Is it that things are moving pretty quickly, so we could be spending money for something that then gets outdated?
Yeah. So I think speaking from the point of view of a large corporate, the thing that is very difficult for us is actually to get the value out of AI that we think we can get, right? You've just got to change an organization completely. And there are three big aspects, each of which is really tough. One is adoption. Do you get the right tools available to people adopt them? How do they adopt them? Second is infrastructure, both in compute and in data and quality of data. And then the third thing is to find those high-value cases where you do something in an AI way, beginning to end, and throw away the old way of doing it, which is also hard. So corporate adoption is hard. And the question is, what is being built in to the equity market's perceptions of values of companies and this money they're spending based on their assumption of corporate adoption, right? Because if adoption is less than what people think, then valuations may be too high.
So what does it mean in terms of jobs? So we had Standard Chartered saying they will eliminate, corporate function roles by more than 15% by 2030. HSBC says it's looking to cut around 20,000 jobs. What does it mean for AI, for Barclays?
The answer is I don't know. There is, I'm being very serious about this because I think clearly there are tasks and activities which will see greater productivity, right? And where you can do something with fewer people than you can today. Equally, this opens capabilities on personalization of services, on actually investing in making existing things more efficient. And I can give you examples. We sample all the calls now for customer service agents. That is better than what we did, but it doesn't reduce the number of people. It makes us have better customer service agents. So these things are going to trade off. And I also think it's a really important thing for corporate leaders to look at the impact on our workforce, on reskilling people, and finding ways to actually use this technology, not just to make our companies better, but to make things better for our customers. This is hard stuff.
Bill Winters yesterday talked about lower value human capital. He received a little bit of backlash. Was it a poor choice of words?
Well, I'll let Bill answer what he meant. But what I would say is that human capital is a really important part of any large organization. And we must use technology, we must invest in technology, but we must also invest in our people. So that, as I said, reskill them, upskill them, get the most. And if I can use a difference, some of these things will help with tasks. What people do are jobs. And a job is much more than a collection of tasks. And that's the thing we have to keep in mind, I think.
Have you seen a concrete business impact already, thanks to some of the AI that you've been implementing?
We're seeing creeping impact.
Okay.
We're seeing things getting on the margin a little more efficient in certain parts. Fundamental impact, I think is coming, but it's not. I don't see it yet.
So you're also one of the largest, UK-based companies, certainly banks. Are you concerned that a new Labour administration would raise the bank tax or corporation tax?
Look, individual things about taxation, spending, and so on, we're going to have to wait to see. What I really think is important in the UK is we've gone for 20 years with relatively low productivity growth compared to the rest of the world, relatively low overall growth, equity investment culture that's declined, lack of investment, less than what you'd like, again, in lots of aspects of human infrastructure and physical infrastructure. And, what you need is a stable, committed set of governments who will do that over a sustained period of time. That's what's required.
So how do you read the situation in the UK right now? It doesn't feel very stable.
I think it would be good to have clarity and stability soon.
Wes Streeting put the reversal of Brexit on the table, right, in his leadership bid. Would the City of London even welcome that at this point?
So Brexit has had a definite cost to the UK economy over the last 10 years. I mean, people have said something, it's like 6 to 8% of GDP, right? I don't know how practical a reversal is, but in effect, it was a form of a tariff between the UK and Europe. And Europe is the UK's biggest trading partner. It's right next door. So I think we should find ways, economic arrangements, that reverse the impact of that. Whether that can be a reversal of Brexit or some other arrangement, I don't know practically. But, you know, it has had a cost. And if we can find ways to lower the cost, we should do it.
Up next, Sherritt looks to hand majority control to a Trump-linked investor as Cuba sanctions loom. We've got more after the break. Sherritt International is moving to hand majority control to an investor linked to Donald Trump, signaling a major shift for the mining company. Now, the move comes as U.S. sanctions on Cuba tighten, adding pressure to its operations there. So let's get more on this story with Sabila Gross from Bloomberg News. Sabila, it's great to have you join us. So I guess, first of all, what exactly is driving Sherritt to consider handing over majority control at this point, and how significant is that Donald Trump link?
Well, it's quite the plot twist today, isn't it? I mean, last week, Sherritt looked like it was on the verge of extinction, to be honest. It really wasn't feasible for them to continue staying in Cuba with the expanded sanctions announcement that we saw at the beginning of the month. So there weren't many options available to Sherritt, and now it looks like one of Trump's close advisors has thrown them a lifeline.
How are tightening U.S. sanctions on Cuba affecting Sherritt's operations and overall financial outlook?
Well, I mean, if we step back a little bit further as well, the regime change that Trump enforced in Venezuela also included a blockade on fuel to Cuba, which meant that Sherritt was already struggling with securing fuel supplies and basically said that they were stepping back from its operations. When the sanctions announcement came out, that's when things got very serious. And Sherritt last week decided to try, at least, to dissolve the joint venture, the joint ventures it has with the state. But yeah, today we've seen a complete reversal, a completely new deal come in. It's shocked everyone, even Sherritt, I think. And they're waiting to see if this can go ahead. The announcement today did indicate that the US is sort of signed this off already, but you know, we're still to see what Canada might have to say about this. Obviously, Sherritt is a Canadian company. It's a 99-year-old Canadian mining company, actually. Mm-hmm. And they have an important strategic asset in Alberta with a nickel refinery there.
Yeah, and speaking of that, like, what are the broader implications that this move could have for investors and for companies that are still operating in Cuba, also under like that increasing geopolitical pressure we're seeing there?
I mean, look, the turmoil that Sherritt was in before this announcement today is pretty indicative that it's still very risky to be in Cuba. We don't know what the US administration is planning on doing with regards to regime change. Nothing's come out about that just yet with regards to how it might impact investors and companies still operating in Cuba. But it looks like they've given the green light for an American party to come in and take over this company.
Okay, we'll leave it there. Sabila Gross from Bloomberg News. Appreciate you joining us. Thanks so much. It's time now for Hot Picks. Today, we looked at 3 dividend-paying stocks to keep on your radar. And for more, we were joined by Michael Klarfeld, portfolio manager at ClearBridge Investments.
I think the first is with returns prospectively looking, more uncertain and possibly lower, dividends give you a predictable upfront return, upfront yield. The second thing is obviously we've been experiencing a lot of volatility in the markets, and that is, could persist going forward. And dividends tend to insulate portfolios from downside volatility. As stocks decline, investors gravitate towards companies with nice dividend profiles because the dividends give a real clear marker of sort of value. And the last piece would be dividend growth and the benefits that that can play in terms of offsetting inflation. Obviously, inflation is higher and stickier than we would like. And as people think about income and their need for cash going forward, particularly in retirement, dividends provide a growing stream of cash flows, which helps to offset inflation.
Okay, so let's get into it then. Blackstone is your first pick, offering about a 4% dividend at the moment. Tell us more about this one, why you like it.
Yeah, so Blackstone is obviously, the marquee name in alternative asset managers. The stock, along with many others in the group, sold off in the last several months on concerns over software and sort of what AI is going to do to software, and also concerns around private credit. In both cases, we think those are overdone. Blackstone, like all asset managers, has some exposure to software, but it's not that significant, and we think they'll be able to manage through it. On the private credit side, we think this is there are companies that will suffer credit losses, and inevitably a large company like Blackstone will have some. But these are very savvy investors who have really the pick of investments that they get to make. So while we expect that there will be some losses, we don't think they'll be that significant. On the flip side, the underlying fundamentals in the business are phenomenal. Blackstone raised over $60 billion in the first quarter, which puts them on track to raise over $200 billion in net new money in 2026, which is really just a fabulous growth rate. And given what we're seeing across the economy in terms of the need to invest in data centers and the capital that requires, alternative asset managers like Blackstone are very well positioned to invest in that and really benefit from that growth.
Next up is Otis. This is in the industrial sector. Tell us more about Otis.
Yeah, so Otis is Otis Elevators, right? So in one sense, a very boring business. But what makes Otis such a great business is that they have a large recurring aftermarket business. So Otis makes 80 to 90% of their money is not on selling new elevators, but on the routine required maintenance of millions of elevators around the world. And those elevators have to be serviced whether the economy is good or bad, and whether every floor in the building is occupied or not. The stock has sold off early this year on concerns around sort of weaker earnings in the first half of the year. We think this sets up an opportunity to buy a terrific franchise. And one of the things that I think people are talking about these days, one of the monikers going around Wall Street is HALO, sort of hard asset, low obsolescence. As we think about businesses that are at risk of being disintermediated by AI, Otis Elevator stands out as one that's very well insulated. So in a world with tremendous uncertainty, you can buy this stock at about 16.5, 17 times earnings with a very predictable revenue stream that should grow over time. It's not the sexiest in terms of upside growth, but we think about it as sort of an inflation-protected bond, which will be very safe and secure in a world that is increasingly uncertain.
Last up is Unilever. I hope I'm saying that one right. This is a UK-based company. Tell us more about why you picked this one.
Yeah, so Unilever is one of the largest consumer products companies in the world, making household cleaners and Dove soap and the like. And it is a terrific company. They have a phenomenal collection of brands that are globally leading brands. A terrific management team led by a CEO who's come in the last 2 years and really upped the cadence of execution. They have a great balance sheet, and it trades at a very attractive price, about 15.5, 16 times earnings, which is a pretty big discount to sort of where Procter & Gamble, its U.S. peer, trades, which is north of 20. We think that there's not a good reason that the discount should be that wide. The dividend is almost 4%, and we see a company with a 4% dividend at 15, 16 times earnings with a great balance sheet, and importantly with volume growth, which is something that many companies in the consumer space are not seeing, and we just think it's a very compelling long-term opportunity.
I'm curious, with this topic, are you seeing investors prioritizing one over the other when it comes to a dividend or a yield?
No, I think that it's important that dividend investing is really always about the balance of upfront yield and dividend growth, and then also to the total return considerations, right? So with dividend stocks, you're still buying stocks which are inherently more volatile than bonds. So it can't just be about the income, but when it is about the income or the income analysis, it's about both the upfront yield and really over the longer term, the more powerful component is dividend growth, because dividend growers can grow their dividends 8, 9, 10% a year, sort of in perpetuity. Some of the best dividend companies have done that. And if you think about that, it's really a fabulous ability to compound cash flows and wealth.
Are there certain sectors recently that are currently offering like the strongest combination of yield and stability or dividends and stability?
I think what we're seeing, which is so interesting, is that because investors are so myopically focused on everything going on in AI and big tech, that they are ignoring some of the opportunities in other parts of the market. So, today we've talked about an industrial, financial, and a consumer staples, and I think that echoes just what people are seeing more broadly, which is with everybody focused on AI, there are overlooked opportunities across the market.
And are we seeing more companies initiating dividends in this kind of environment, in this climate, or pausing increases? Are you seeing any trends in that sense?
Dividend growth continues to be healthy, and broadly speaking, we think that can continue. The dividend growth story has been a good one over a long period of time. So I think if I was on this show 20 years ago, a long time ago, there would have been a lot of sectors that would have been tough to invest in, namely technology, right? A long time ago, most large tech companies did not pay dividends, and the only ones that did were seen as sort of, yesterday's technology. Today, most of the largest technology companies do pay dividends. So Microsoft, Apple, Meta, Alphabet, Oracle are all meaningful dividend payers. And so one of the great things now is that it used to be a bit of a limitation if you were looking for companies to pay dividends. That's much less true today.
That was Michael Klarfeld, portfolio manager at ClearBridge Investments. Well, still ahead, we've got today's market movers with Bloomberg's Avalon Purnell, including Intuit, announcing a 17% increase to its workforce. More on that straight ahead. Joining us now for some movers south of the border is Bloomberg Equities reporter Avalon Purnell. Avalon, it's great to see you. So we're going to start with Intuit announcing today that it's cutting 17% of its workforce ahead of earnings. How are investors reacting to this news?
Yeah, investors are definitely not reacting well to this news. Intuit is down nearly 4% today after announcing that they plan to slash up to 17% of their workforce. And that is in a push for greater efficiency and potentially diving deeper into the AI world. Citi had a great note out writing that they see that the market is pricing the news as a negative demand indicator into earnings. Intuit is actually expected to report earnings later today for their third quarter results. But it is worth noting that Citi is also writing that they still expect a beat and raise quarter on the back of a pretty solid tax season. So we'll definitely keep an eye out for that after the bell.
Yeah, I mean, look at that drop in that one-year chart, though, right around February, March, Intuit going quite downhill. Yeah, as you say, reporting later today. We'll keep an eye out for that after the bell. Immunovant, in the flip side, rising today despite an earnings miss. So what's going on there?
Yes, Immunovant surged more than 36% today, poised for its biggest one-day leap since 2023, and that's after some pretty positive preliminary data, more specifically for their drug that is set to treat this hard-to-treat population of patients that have rheumatoid arthritis. And part of that is having this really impressive data. Piper Sandler writing in a note that the data showed really impressive response rates and also potentially supports the drug being best-in-class opportunity. So even though it's still early days yet, investors are taking this as a really positive sign.
For sure. Okay, Bloomberg's Avalon Purnell joining us with those two movers. Avalon, thanks for that. Appreciate it. We're going to take a look at now how markets are trading on Bay and Wall Street before we wrap things up here. We'll start with the TSX, seeing some gains today. It's up more than a full percentage point, well above 34,000 points now. So seeing some gains, particularly the info, tech, and materials sectors are boosting the TSX up today. We know the price of gold is rising as Donald Trump says the U.S. is in its, quote, final stages on Iran. A couple of different comments coming from the U.S. President Donald Trump today, but gold reacting to that. And then, of course, that pushes up a lot of the companies on the TSX, which we'll talk about in a moment. We're also watching U.S. markets, of course, all in the green, too. NASDAQ in particular up 1.2% at the moment. Investors watching here, obviously, Nvidia, a big story today, reporting after the bell as well. And it seems as though a lot of investors optimistic about that news, waiting to see what Nvidia says and how that could drive up tech stocks. As I mentioned, we're going to take a look at some of the movers on the TSX. Go Easy is the biggest gainer on the TSX at the moment, with shares up the most in 2 months. It's up more than 11% right now. Seabridge Gold trailing Go Easy. It's up quite a bit, as I mentioned. The price of gold rising and the materials sector on the TSX seems to be boosting the overall index up quite a bit. Seabridge Gold up almost 11% at the moment. And then on the flip side, Allied Gold is actually the biggest lagger on the TSX so far today, dropping the most in 18 weeks. Join us today at 3 p.m. Eastern for Know Your Options with Chris Tom of Moat Financial. You can send in your options trading questions now to Know Your Options at bnnbloomberg.ca. That is just in about an hour's time. That wraps up this edition of Trading Day. Thanks for watching.